lesson plan for today. Chapter 9, as I said, is a big deal for today. So now onwards until 10 o'clock till 11:30 is all about chapter 9. Yeah, definitely chapter 9. Then 11:30 till 12, we're going to take a break. Then chapter 10, 12 till 1. But I'd like to keep one of the questions from chapter 9 in the second part of our lecture today. Two sessions we have. First session, we're going to do chapter 9 thoroughly. The hard bits, there are goodwill is there, non-controlling interest is there, intercompany transactions are there, a little bit of loan is there, dividend, a little bit of dividend, but quite a lot of workings. Yeah, it's all about practice. So that's what we're going to do in chapter 9, first half today. And as I said, after the break, I might give you one of the questions to do. Lengthy question, I'll give you good enough time to do it, or at least few of the workings from that question. Then we're going to do chapter number 10 for the in the second half. In the second half, I'll give you one question from chapter number 9. Yeah, that is our planning, and I hope that is enough for introductory talkie. I think it's started. And before start, as you know, I check the enthusiasm meter. So, are you ready to start? Please write back to me something. Yes, started with Honey, Hakan, Mary, Rosie, Jordan, Abby, Isabel, Nika, Charlotte, Nirose, Camellia. More people, more people. Come on, more people are there, I know. Participate, yeah? This first, yes, is Jessie, thank you. At least write something, isn't it? It gives you like, yes, you're ready, you are not lazy, yeah? There's no wrong answer writing and yes here, yeah? This is not a true false. Like if you say false, you are getting wrong. If you say true, you're getting it wrong. Nothing right there. You're not losing any marks here. Thank you, Ali. Okay. So page number 231, it says 250 something in online. Parents here. Okay. Last week, this chapter number 9, Group Accounts Consolidated Financial Position, and this week, last week I showed you how is your parents' account separately. Yeah, when they invest and just separately. How does a group financial statements looks like? And what is a subsidiary? Easy things. This week, today, we're going to go in detail out goodwill, then intergroup transactions are there. Inventories, PUP would be there, provision for unrealized profit. Fair value acquisition, easy, and especially non-controlling interest, NCI. So these are the talkie and topics we're going to go over. Yeah. So this chapter, activity 1, 2, 3, we have finished, which is easy. If any one of you have missed it, you can check it out from our. You can check it out from the connected to from last video. Last lecture's video, a little bit of post-acquisition reserves, like your retained earning at the beginning, if it is 500 when you bought it at acquisition, we call it at acquisition. You bought a subsidiary, PE bought in as 100% owned, could be even 80% owned. Later on, we're going to get 80% or 90% owned. Yeah, like there will be non-controlling interest. So at acquisition, the retained earnings of S plus 500 at year end, retained earning is 800. So 300 retained earning gonna go up. 300 has gone up. A portion added with the parent company. That's what we can show today. So starting with the goodwill. Basically, exam style question comes from here about. Exam style questions come from this topic number 5. Goodwill, starting with the goodwill. Generally, you know, the goodwill is the difference between the amount we paid and what is the worth of the subsidiary. P has bought a subsidiary, maybe 80% of a bought a, 90%, could be 100% sometimes, but now onwards, you're going to see 80% or 70%. Yeah, not fully. Yeah, a little bit control they will not have it. Non-controlling interest, we call it. Now, P bought S for £100, but the assets and liabilities, oh, the worth of the S was £80. That means 20 paid extra. That is goodwill, right? Yeah, this is the same idea here as well. Same similar idea with little extra work we're gonna do. With little extra work, yeah. Look at this, they said consideration transferred, like we have paid $100 pound, but the less fair value of the identified assets and liabilities at acquisition, the value of S, the fair value of S, what is the market value, worth of the S was 80. So 20 is the GW, goodwill. Yeah, that's how you basically do the goodwill. Okay, hold on. I have received a mail from one of the Ali, one of my old students. He says, your video's gone. We can't see you. Oh, of course I see you can't see me. Don't worry about the picture. Yeah. Oh, I was wondering. Can you see the screen, Ali? Yeah, or everybody? I hope you can see my screen and writing. Yeah, and voice. Do you see it? Right back to me, everybody. Those of you see it. Yes, Charlotte. Thank you. Thank you, Charlotte. Thank you, Rosie, honey, everybody. Thank you. Lovely people are there, Mika. Okay, that's enough. Video will be off most often because I'm writing it. It distracts also. It takes a little bit of, you know, memory. The like slows down sometimes. So not need the video. Yeah, loads of work we got to do. Okay, thank you, Mary. Skin and hear your voice. That would be great. My video would be off at different points. Yeah, because while writing, I go beyond the video, so it might be off. Don't worry about it. Like now I'm putting it off. So my video is off now. All right. Hey, but I wanted this chatting box open on me on my screen. As soon as I try to write something, chatting box gone. So I don't see whoever is writing back to me unless I deliberately check it out. Anyway, so people, accounting treatment of your goodwill is something you need to memorize. It's something you need to memorize. This is the one. This is working number one, in fact. There are minimum 5 workings. Working 1, 2, 3, 4, 5. To master this chapter, 5 to 6 workings are there, or 5 to 6 adjustments are there. So working number 1 is this, then there's a working for retained earnings, there's a working for non-controlling interest. These are the big workings. Working number 1 is for goodwill, retained earnings, non-controlling interest. Working could be for PUP, provision for unrealized profit. Then receivables and payables at the end, trade receivables and trade payables, we'll just cancel it. What else? I remember working goods in transit, we call it, or cash in transit. Those are little workings. Anyway, so the first working here is consideration you paid plus non-controlling interest at acquisition. Yes, you need to memorize it. You need to learn it by heart. Yeah, I will show you some calculation. It will make more sense that time. And so consideration is how much we paid. We means P, parent paid to subsidiary to buy all of the subsidiaries assets and liabilities, plus non-controlling interest, which is another working, we got to work it out. At acquisition, less net assets that acquired, less impairment. Net assets of S subsidiary, less impairment. Impairment is the loss in the value of the goodwill, like just like you can say depreciation. Yeah, the depreciation of goodwill, we call it amortization, but this time is impairment. The value has lost. It needs to be taken away. Impairment has only one treatment, that is in the goodwill deduction. Just remember. I repeat, in this chapter, you need to memorize and remember a lot of items. That's why lots of, what do you call it? Practice needed. Practice, practice, and practice. So let's get started without wasting any more time. And they said non-controlling interest we're going to discuss later on, or we're going to discuss later on. Let's just focus on goodwill now. Okay, for impairment, double entry of the impairment. Impairment is a loss in the value of your goodwill. Loss in value of GW, goodwill. So your goodwill goes down. Goodwill is an asset, so it becomes credit, and your retained earnings, it has a relation with your retained earnings. Your RE goes down. Your retained earning goes down. Retained earnings generally is a credit item, so if it goes down, it's debit. See, you need to memorize this one as well. Note, we have reached an activity. BPP has given you so many activities here, so I need to work out this activity very slowly, easily. We can see some talkie given here. I can see two companies given. One must be parents, one subsidiary. I'm just going at a glance, then I'm going to go in detail, all right? Assets and liabilities and equity, also many things are given. At the end, further information, that's very important. Further information is very important. In the current year, the directors of Thatch PLC have concluded that goodwill is impaired by 1 million or 1,000. 1 million, because these are given already in 1,000, so you can ignore the 3 zeros at the end. It's 1,000. So your goodwill is impaired by 1,000. Goodwill is impaired by 1,000. What is this entry? Your GW going down, goodwill credit, right? And RE, it is related to retained earnings. Oh, sorry, RE. RE is going down as well. Yeah, that's it, by 1,000. That's only one new thing you got to do. And then you are required to do consolidated step partial position. Few items here we're going to do, but before that, you always, this is your working one. Working two here is retained earnings. These are two workings you've got to do. There is no non-controlling interest. Why? There is no non-controlling interest. Let me read the question now. You understand. Look at this. I'm reading the question from top to bottom. We're going to follow the top-down approach. From top to bottom, all the things we're going to read out, and we're going to check it out, right? Reading it for you. Thatch PLC acquired 100% of the issued share capital and voting right of straw. That means P bought S 100%. That is our group structure. Fully owned. There is no non-controlling interest. There's nothing that P doesn't control. Fully controlled by P, right? Great. Moving on. So, limited 1st of January at the beginning of the year, yeah? Beginning of the year for 8 million. Okay, so consideration paid. This is your consideration paid. Do remember. Yeah, what is this figure? This is the figure you write here, 8,000, don't you? Yes. Moving on. At the start, Straw Limited had an issued share capital of 3,000 or 3 million and retained earnings. That's your opening retained earnings. 3 plus 2 equals to 5. 3 plus 2 equals to 5 was the worth of the asset. But how much we paid? 8. You might be thinking, oh, 8 minus 5, that means we paid 3 extra. Not actually. There is an impairment of the asset. Yeah, there is an impairment of the asset. So of that, we need to basically 1,000 impairment. 1,000 should be taken away from the goodwill. Goodwill was meant to be 3,000. Yeah. Let me do it. At first, I'm not reading even the, what do you call it? This box. This is the easiest thing. You should not be bothered even. Like assets and like all the items in between, you should not be bothered. I know there is a plant and equipment. I know there is an investment could be. I know there is a current asset, current liability, blah, blah. So I'm not that much bothered. I'm not that much concerned about what is given into the assets and liabilities. These are just normal things, assets and liabilities all the time given. But I am very, very much concerned about these items. You know, the 8,000, how much we paid, consideration. How much was their worth of the assets and liabilities? 3 and 2,000. They mean subsidiaries, yeah? I'm concerned about this and how much we paid it. Is there any more information? Yes, there is impairment. Impaired by 1,000. So let's do our first working then. Yeah, our first working number 1, people, you people can help me here. We write first one, consideration. Maybe spelling is there not correct. Don't worry about it. Oh, just I'm writing in. How much was we pay? How much we paid? 8,000, right? Do you agree with me? Then what was the assets at the acquisition? We call it net assets at acquisition. of at acquisition. What is the asset acquisition? 3 plus 2, you agree with me? At the beginning, share capital and share retained earnings was 5,000, wasn't it? You take away, generally, as I said, 3,000 should have been your goodwill, but no, there is not. There is a what? Less impairment. For the impairment is making your goodwill down. Less impairment of the goodwill. 1,000. That's it. Whatever is remaining, I think 2,000 is remaining. That is your goodwill. Hope it makes sense. Easy peasy. Oh, many of you have worked it out. Well done. Thank you, Hakan and Jesse. Yeah, please keep moving. Okay, that's the first one. Retained earnings, if you remember from last lecture, or yeah, last lecture started. At first we do parent, don't we? Parent retained earning, we copy paste from the SOFP. I'm going to do it. Let me show you the structure. Of that, you add the subsidiary, but only attributable to the parents. Subsidiary, what do you call it? How much is attributable to the parent? Retained earnings of the subsidiary, we call it attributable to parents. Basically, we got to do a little extra work here, like how much retained earning has increased from the beginning to the end. Yeah, let's copy paste first. I need to do loads of up and down here. Parents is retained earning 6,000. You're gonna copy paste, and subsidiaries retained earning at the beginning. Would you agree with me? It was 2,000, and at the end it became 5,000, right? So 3,000 has gone up. That's just remember, 3,000 has gone up. At first, let's write down the parent 6,000. Copy paste and get our easy marks 6,000, and attributable to parent. How much is attributable to parent? The closing subsidiary retained earning is 5,000, and opening was 2,000, wasn't it? 2,000. And how much is owned by the parent? Fully, 100%. Fully. Yes, that's what you need to memorize. You need to understand. You need to learn. So it's 3,000. It is 3,000. Okay. Now, basically, these are the items I did working because of that. 6,000 plus 3,000 of that. If you remember the double entry of let me take you there. Goodwill credit, retained earnings debit means both of it goes down. Retained earnings should go down by the impairment amount, right? So you need to make the impairment out from here. Impairment minus how much? 1,000. Yeah. Right. Okay. 1,000 was erased. 6,900 minus 1, 8,000 should be remaining. I hope you people are fully aware and good with the, thank you, Hakan, calculation. Simple, these two calculation. If you do 2-3 more times, you will understand. It's not understand, you will remember for until your exam, didn't you? I would like you to remember until your death. No, you might ask me, Elias, why are you talking about death? Death means until you serve as an accountant, yeah? You should remember these things. Obviously, some of you might choose for cost accounting later on. Maybe you become auditor, maybe you become tax expert. But this financial accounting, you should know the rules. You should know. Okay, 3,000. Rabi asking again. It's the retained earnings from the subsidiary. Then how do I getting from 3,000? Okay, Rabia is asking, how do I get the 3,000? It is basically the opening RE compared to closing RE of your subsidiary. Now opening was 2,000 and closing was 5,000. 3,000 increased. That means 3,000 profit made by the subsidiary. 3,000 profit made by the after purchase, after acquisition. So the closing retained earnings, which is attributable to parent company, is 3,000. And because they own 100%, fully goes in it. later activities, you will see 80% goes in it, 70% goes in it. Yeah, I hope it makes sense. That's how I got 3,000. I hope all of you are good with these two workings. Please write the formula right now. Write down. What is the formula of goodwill? Consideration minus net assets of the subsidiary at acquisition. Yeah, which is your share capital and retained earnings, 5,000, minus an impairment. That's it. Yeah. For extra work we might need to do, we'll see later on, especially with the retained earnings, we've got to do a little extra work. If there is any provision unrealized profit, we need to take away. Yeah, I will show you provision for unrealized profit, especially the inventory. Okay, so only two workings we have done. Let's do the question now. Let's do the question now. I'd rather like to open another page on screen here. Maybe 266 to 65. Okay, and yes, this way. And it's better. What I'm doing, I'm opening two pages, yeah? And which one's the question, by the way? This one insert is a question, yeah. Okay, what I'm doing this way. Yeah. So two windows I have opened. One for question, one for writing. One for writing. All right, just bear with me. Nice, better now. Right, let me take a pen here, which been taken. Okay, I need to make a little bit of not that big. This is the one, let me set it here. It's insert, I hope. One minute, please. Give me 1 minute, yeah? Just 1 minute. I'm setting it out. Was so talking so what do you call it? Low, with low voice. That's why maybe some of you couldn't hear me. Can you hear me now better? Good. Is my voice good? You can hear me? Okay, Mary. Thank you, Mika. All right, honey. Thank you. All right. I wanted this to be better. Okay. Yeah, okay, it's good now. Now I can work it out. Okay, let's work it out. So how are we going to work it out? Can you see property, plant, and equipment? I'm going to take it on over here. Property, plant, and PPE. It's just line by line add up, okay? Make your life easy, line by line add up. 10,000 plus 5,000 I have added up. It gives me 15,000, right? It's taken. Investment is Troy, doesn't go, but what goes in? Goodwill, GW, we have worked it out. There isn't working on goodwill. How much is the goodwill? Let's check it out. Goodwill is 2,000. Do you agree with me? Goodwill is 2,000, yes. Okay. So that is my 2,000 taken. Job done here, but added up, there's a figure given, 15 to 17,000. Yeah, we can do little mental maths, but what do you call it? That what is this extra box? Sometimes they're horrendous. Yeah, whatever. Oh, that is for current asset, maybe, because they said total asset, right? Isn't it? Okay, that is for current asset, yes. That's your current asset. 4 plus 5, yeah? Current asset. So CA, I'm writing CA. Current asset, 5,000 plus 4,000. This is 4 plus 5 is 9,000, yeah? And you get total assets, 17 plus, I'm using local calculate, 17 plus 9 is 26,000. Yeah, that's your total asset. You agree with me? Easy and nice. You see, only the hard bit was to deal with the goodwill and all these items. Now, in the equity section, what do you take? Share capital P only. Share capital P only. And which is 9,000. And then retained earnings, we have worked it out. Retained earnings, not just P, it's parents plus subsidiary, but from the subsidiary, we have worked it out. How much is attributable to the parent at the end? and total parent plus subsidiary you have worked out, and even there was an impairment which taken away 8,000. So total is 8,000 for retained earnings. And yeah, 17 it makes, right? 8, 9, 17. 17,000. Liabilities, it's just line by line add up. There's only 2,000, so it should be 2,000. There's nothing on the subsidiary side. So it's a non-current liability. Non-current liability, it's 2,000. And there's some current liability, CL, 5 plus 2, which makes 7. What do you get? 7? 5,000 plus 2,000. Such an easy stuff. So that's why I didn't put that much of emphasis on the SOFP itself. The much emphasis you need to put on where? Working. Oh, they said group structure. Group structure is 100% owned. P own S 100%. That's how you do the group structure. How much is that then? It's 9 though. If these two add up, a little horrendous way of doing it. And then this 9 plus 17 is how much? Take the digital calculator on screen. You can give me the calculation. 17 plus 9. I got 26. Then we don't need to even check the answer. It has matched with our total assets. It has matched with our total assets. Let's see. Many of you have worked it out. I'm really glad. Hakan, Rosie. Yeah, thank you very much. And that's how you do it. Are you happy with the goodwill and retained earnings so far? Yeah, you should be. Now onwards, I'm going to do with the next one, non-controlling interest. And what is a non-controlling interest? The percentage which is not being controlled by the parent. Let's assume parent owns 80% of the subsidiary. That means 20% is NCI, non-controlling interest, right? Yes, 20% is non-controlling interest. So there are so many talkie given. You can read it out later on. There are two ways of doing it even, two methods, fair value method and proportionate share method of doing your non-controlling interest. Remember, in your assessment, proportionate share of method is needed. Is in general, simply, what is non-controlling interest? The percentage, answer is the percentage not owned by the parent, yeah? Like 20% here. Yeah, let's assume £100 is the value. So 20 pound is not controlled by the parent. 80 is controlled by the parent, right? We need to check it out. We need to calculate it. How do you do it? Two non-controlling interests you need to do, people. How many? Two. Number one, at acquisition, non-controlling interest at acquisition, and non-controlling interest at the year end. All right? Okay. So stay focused then. At acquisition, when you buy your subsidiary, P again buys the subsidiary, maybe 80% they bought it, 90, 70, whatever, not fully. What is the non-controlling interest at that time, at the time of purchase, acquisition? What do you do basically? Share capital, share premium, retained earnings, and revaluation reserve of S subsidiary. We take all the value. We take all the value. Any value, it could be like 100, 20, 10, 10, so 140, yeah? 140 was the value of your subsidiary, but how much you do not control? Non-controlling interest, let's assume 20%, and that is the answer. Okay, 140 was the value, the worth of the entity, subsidiary. Of that, how much you do not control? 28. That is your non-controlling interest at the beginning. Then we got to check out the non-controlling interest at the year end. Non-controlling interest at the year end. How did you do? 3 items only. Or 2, mostly 2, but this time they gave you 3. All the possible items. Non-controlling interest at the year end is the one you got at the beginning, non-controlling interest at the acquisition, that figure, like 28, plus non-controlling interest share post-acquisition retained earnings. Like once you acquired the subsidiary, once you bought the subsidiary at the beginning, maybe the retained earning was RE was any amount 500, and at the year end the RE is 600. How much it has gone up by? 100, isn't it? 100. Of that 100, how much you do not own? That is the percentage here. Yeah. Post acquisition retained earnings. Yeah, like as I said, 100 you do not own, 20%, which is 20 again. 20. That's how you do. Not just retained earnings, that could be revaluation reserve or any other reserve. So for the closing, you need to remember, for the year end, you need to remember opening NCI at acquisition or NCI at acquisition plus non-controlling interest of post-acquisition retained earnings. That's it. We'll do with some works. It will make more sense. Yeah, so stay tuned with me. Activity number 5. Apple Limited acquired 600,000 £1 ordinary shares in Orange Limited for 4,000,000. So that is the consideration being paid on 1st of January. And at that date, means at the opening, remember, at that date means 1st of January, the capital and reserves of Orange means at acquisition, at the beginning, how much is the capital and reserves? The shares are 1 million. Shares are 1 million. How much owned by Apple? 600,000. So what percentage Apple owns? What percentage Apple owns? Don't give me any answer. Just give me answer what I'm asking you. Yeah. What is the percentage? Like P over S. What percentage is being owned by P? Tell me. What do you think? Write back to me. I'm waiting for your answer. Okay. One answer from Hakan, which is right. Vivian, which is right. They're different, giving me different answer, but all of them are right. Hakan says 40% non-controlling interest. Vivian and Mary says 60% owned by the parent. Absolutely, both of these are the same thing. One of them are saying the glass is full of half water is there, and another person is saying half empty. It's the same thing. Yeah, 60% owned by the parent. How do you know it? 600 shares owned out of 1,000 shares. That means non-controlling interest is 40%. Yeah, that is also very much needed. Here at acquisition, how do you do it? Acquisition, yeah. And we're going to do the goodwill as well. So at acquisition, how much was the value of the asset? Let's put those values even at acquisition. I'm erasing these things. Yeah, I'm using the same box. It's share capital 1,000 and retained earnings 5,000, isn't it? 1 and 5. Let's write it down. 1,000 and there's no premium, 0. Retained earnings 5,000. There's no revaluation reserve, 0. So altogether is how much? It's 5,000. But how much is your NCI, non-controlling interest? 40%, right? 40%. What is the 40% of 1,000? Sorry, 5,000. 5,000 times by 40%. Oh, hold on, it's 6,000. My bad. 5 plus 1 is 6,000, isn't it? 1 plus 5 is 6,000. Why did I say 5,000? So let me check it out one more time. 6,000 times by 40% to 400. Do you agree with me? Can you please work it out? Then I get a little confidence that yes. See? All right. So thank you, Abby, Mary, Vivian. Well done, well done. So 400 is your non-controlling interest, right? 100 is your non-controlling, 400 is your non-controlling interest. That's one that is being done. So let's see whether it is that is not being asked yet. Calculate the amount of goodwill erasing. But to do the goodwill, you need the NCI at acquisition, don't you? NCI at acquisition. Yes. People, you need to memorize these things. Let me show you the earlier one we have done it. Goodwill we have done. I'm taking another color pen here just to show you. You know the goodwill consideration. Okay, it's not given here. Good, but it is given into the pro forma. Yeah, there we go. That's the pro forma. Goodwill, consideration plus NCI at acquisition. Can you see? This is our 2,400. Let's check that out here, like how much we paid it. And can someone tell me how much we paid it? Them. We have paid some money for 600,000 shares. Check it. How much we paid it? Gosh, it's so bottom. 4,000, right? Thank you, Hakan. 4,000. So the formula, let me draw the formula here. Like very little space, by the way. Let me erase these things. Let me do it here. Consideration is 4,000. We paid it plus NCI at acquisition, isn't it? Yeah. At acquisition, ACQ. How much was the NCI acquisition? 2,400. We calculated. Yeah. And less net assets and liabilities, or net assets secured. Net assets secured. What is the value of the net assets secured? It's given 5 plus 1 or 1 plus 5, whatever you say. Yeah. At the beginning, 1,000 share capital, 5,000. That was the worth of the assets. That is net assets secured, which is 6,000. 6,000. Take away. You're gonna get your goodwill. Let's check it out. 2,400 already there, plus 4,000 is consideration minus 6,400 is the goodwill. I'd like to check the answer here because last time I didn't check the answer. Did you get 400? Oh, good. Some of you are getting it 400. Well done. Well done. That is your goodwill, people. But do you see, we had to go to the extra mile. At first, I needed to do the NCI at acquisition. NCI at acquisition, which is this 2,400. How did I do it? What is the value of the capital? What is the value of the RE? Get it and get the percentage and do that non-controlling interest. 2,400. That's number one. You can say working one for this one. There is no post-acquisition given. There's nothing to do with the year end for the NCI. But to do goodwill, you needed to do another working, W2. So these are very common and must workings, which you need to master. All right. Okay. Now let me do some non-accounting calculation. Non-accounting. This is an accounting calculation. You need to learn it by heart. You need to go this way because accounting works with a presentation way, pro forma way. You need to learn this pro forma. Consideration for goodwill for GW. You need to learn consideration plus NCI at acquisition minus net excess acquired and impairment even. Yeah. Impairment. And one more item can go here, which is PUP, I call it. I'll show you later on. Provision for unrealized profit on inventories unsold at the year end. So this is, you need to remember by heart. It is an accounting way. What is a non-accounting way? Let's go through the non-accounting way, which is even more fun. That doesn't come in the exam, but that's for learning purpose, which is good. Non-accounting way, you can say, okay, you can say like you are going to buy 6,000, 60% of the 6,000, isn't it? Not all of it, 60%. You agree with me? You're going to buy 60,000 of the 6,000. 6,000 is the value of orange. But how much you're buying? 60%. Let's do the 60%. I'm showing you non-accounting. Like let's assume you're not an accountant. You're doing just a little bit calculation. You're going to buy 60% of. So normally you should pay 3,600, shouldn't it? 6,000 times by 60%. 3,600 is the worth of the asset, isn't it? But how much you paid? 4,000. Yes. How much you extra paid? Yeah, there you go. 400. That's your goodwill, isn't it? Now you may say, Elias, this is a cool way of doing it. This is an easy way of doing it. I would like to do this way. Allowed to do this way, yeah? You're not allowed to do this way. You have to show the non-controlling interest. There's a presentation. There's a way of doing it. And that's the way of doing it. Happy and good to go. Yeah? Hope happy and good. All right. I'm going to into the illustration number 4, consolidated financial position. Yeah, as always, this bit is important always. And this bit I can ignore for the time being. It's an illustration, and these are important as well. They've done little works. Okay, so many works and steps until activity 6. Let's do it together. Okay, erasing. Now, consolidated state financial position on 1st of January 2014. A Limited acquired 8,000 shares or 8 million shares in B. On that date, means on the acquisition date, the retained earnings of B was 10,000. At 31st December 2014, at the year end, you remember. These are really important. By this time, I hope you are good with the year start and year end, because you're doing level 4. State financial position of A and B were as follows. Okay, let's see the group structure. What would be the group structure? Now, they gave you the answers here. I'd still like to show you the answers. Like, you own 8,000 shares out of how many shares? Out of 10,000 shares. Okay, because in B, how many £1 worth of shares are there? 10,000. So if you own 8,000, that means you own 80%. That is your group structure. B owns 80% of S. So what is your NCI percentage? Tell me. What is your NCI percentage? Non-controlling interest. Excellent. Yes, it is 20%. Without any doubt, it is 20%. You remember that one. So group structure is this. Then the second one is goodwill. We already know what is a goodwill. Now, you need the consideration plus NCI at acquisition less the fair value of the assets you acquired at the beginning of S of subsidiary equals to goodwill, isn't it, people? How much is the consideration? Consideration is how much you paid it. How do you know it? It's not given in this, I mean, in here. It's not given here, but where it is given, it is given into the investment. 25,000. Okay, please do remember 25,000. You have given A, you have invested in B. A has invested in B. You means you are A. Yeah? When I say you are A. Consideration is 25,000. You know the work we have done earlier is the same work I'm doing. Consideration 25,000 instead of 4,000. You can consider 25,000. That non-controlling interest at acquisition, you need to work it out, don't you? You need to work it out. How do you work it out? How do you do it? The share capital and retained earning of S at the beginning. At beginning. What do you mean by S? Subsidiary, yeah? 10,000 and 10,000. Let's check it out. Is it 10,000 and 10,000 not? Yeah, it is. I'd like to erase and highlight again. At the beginning, on that date means on 1st of January, you can see I'm highlighting, retained earnings reserves is 10,000. So your RE is 10,000 and your share capital is 10,000 as well. Okay, so that's how you know it is 10,000 and 10,000. The total worth of the asset was 20,000, wasn't it? But of that 20,000, you need to take the NCI, non-controlling interest at acquisition. How much you do not control? 20% you do not control, which is 4,000. Yep, that 4,000 is added into goodwill. Remember, this is all about GW, goodwill. Consideration plus NCI, less fair value of the assets at acquisition, which is 20,000, you already know. Yeah, 10 share capital plus 10 retained earnings at the beginning. How much is goodwill? 9,000. See, people, I'm doing the work, in fact, third time. This is the third time. By this third time, I hope you're very good with the goodwill. At least these three you should do, shouldn't you? How much you paid for, what is the NCI at acquisition, we're doing little workings in it. And less, what is the worth of the asset at the beginning? Their asset means subsidiaries. Our asset means parent, yeah? And how do you get the NCI at acquisition? Yeah, the value times by 20%, whatever you don't own it. Simple, right? Let's see, what did they say about step 3? It's about retained earnings, RE, retained earnings. People, retained earnings is a good working, big working. And for the retained earnings, if you remember, I did is a parent retained earning. I mean, yeah, PARENT, yes, parents plus subsidiary attributable to. how much of the subsidiary belongs to parents? You know, let me show you. Parents is 75,000. Let me show you. Go into the question. Retained earnings of the parent is, I can do, you know, the way I was doing. Yeah, this way, no? What we're doing, yeah, this one we're doing. So we can do this way. Yeah, better. Now look at this. Retained earnings of your parent is 75,000. Okay, taken on the left-hand side, taken, great. But would you take 15,000 from your subsidiary? No, because first there is a non-controlling interest. You don't own 100% of it. And also there is, at the beginning it was 10,000, at the end it is 15,000. How much it has increased? 5,000 it has increased, isn't it? That's what you got to do. 15 minus 10 on the left hand side, minus 10 equals to 5,000. 5,000 is attributable. 5,000 is the gain, new gain into the retained earnings. Maybe you had a profit into the SPL, and after dividing all the taking your dividends. But of this 5,000, you cannot attribute all of it as your retained earnings. Why? Because you do not own all of it. 5,000, you own 80% of it. So 80% makes 4,000. 75 plus 4,000 is 79,000. That is your retained earnings. That's another good working, people. Okay, that is your retained earnings. That's another good working. Next one is NCI. This is the non-controlling interest of the net assets of the B Limited at the reporting date, means year end. Year end, non-controlling interest. Okay, non-controlling interest at the beginning was 4,000, and at the year end, you know, 15,000 was the RE of your subsidiary, minus 10,000, 5,000 was attributable, but of that, how much you do not control, 20%, that gives you £1,000. So ultimately, your non-controlling interest year end is 5,000. So this is another working. For NCI, you need to do two workings. NCI at the beginning, okay, people? Non-controlling interest at the beginning, which we done here. NCI opening and NCI closing. Non-controlling interest closing. This is the one. NCI closing. So two workings for NCI, non-controlling interest. And one big working for RE, retained earnings working. One big and good working for goodwill. Goodwill is a working, isn't it? After doing all these workings, we got to transfer it to the standard financial position, SOFP. SOFP, standard financial position. See, at the beginning we started the goodwill, and there was a working which we have done at the top. Bring it down here. Property, plant, and equipment is given 60,000. How do you know it's 60,000? Follow on the right hand side. I'm drawing 50 plus 10 equals to 60,000, right? That is being taken here. Yes, there. Two different color pen, by the way. Current asset is 65,000. How do you know it's 65,000? You add 40 plus 25 on the right hand side of my page, the two page I have opened. So 40 plus 25, it makes 65,000. Hope it makes sense. Add up all of it, you get your assets. Share capital all the time, P only, and that is on the right hand side, share capital. I just circled for you. Retained earnings, we have worked it out, 79,000. How did you work it out at the top here? Where about? There we go. That's the one arrow on the left hand side. Then they did an adding up. Non-controlling interest. It's a working. It's a closing NCI. It's a closing. People, why we do two NCI? The opening we take where? Tell me who writes me the good answer. Opening non-controlling interest. Where do you take it? I'm giving two options. Opening non-controlling interest, we take it into the goodwill, true or false? Not two options, just true or false. Opening non-controlling interest, we take into the goodwill, true or false? I got one answer, two answer, three answer from Vivian, Rosie, and Jordan. All of them are correct, and Mika is correct. Anybody is writing true? You are correct. Thank you, Mary, as well. Yes. So opening NCI is why do you do it? For goodwill. And closing NCI, why do you do it? For SOFP. Okay, it goes into the SOFP. 5,000 working we have done here. Where about? That's the one. Okay. That's it. The current liability, you get 25,000 because on the right hand side, look at this, 15 plus 10, it gives you 15 plus 10, 25,000. And that's it. That's how we do. Happy. Yep. Well done. Well done and good going. That's how we do basically the work over here. Okay. All right. Now, question number 6. I have kept one big question for you. At least not like at least goodwill, retained earnings, NCI. These are the workings you got to do for me on that big question. This one I'm gonna do charge PLC. Oh, I can check your knowledge right now. I can check your understanding. Of course, Rosie, loads of working. You're going to be an accountant after passing. Rosie says loads of working. Yeah, because after passing this module, I hope all of you have done management accounting. Okay, tell me how many you didn't do management accounting costing. Well, not costing, management accounting, budgeting and decision making. Is there anybody who didn't do management accounting? There are 2 more modules. Viewance is not yet. More people, you can say me. That means everybody has. Oh, amazing. How come haven't done it? Yes, in level 4, Charlotte. Oh, Rosie, you done it. Well done. Mithali didn't do it. Rabia says I'm no. Honey, I'm in level 4. Yeah, it is level 4, but there are 2 more modules. You know, apart from this one, have you done 2 more management accounting? Who has done? Anybody? No, Rosie, no. Charlotte, yeah, I am done. This is my last 2. Charlotte, well, great. Camelia Dane, Mika Dane, great, great, great. Honey, 2 more module left for me after this. Okay, maybe the optionals, right? And the synoptic. Mary, level 2 and 3. No, Mary, don't worry. Level 2 and 3, little bit of management you have done, but in level 4, there are 2 more management accounting modules. Haven't done it. There are very mixed answers. Have 3 more modules. Okay, by the way, these only 3 core modules in level 4. Yeah, and of these 3 core modules, let me open my camera because I'm not writing. 2 management accounting costing, only 1 financial accounting costing. This is the one. Yeah, this is the one. So once you pass these modules, you get a license, like obviously level 4, including the optionals and synoptic. You get a license. In United Kingdom, you can practice accountancy practice. You can practice anything. Only you cannot do external auditing. You need to do it. There are hundreds of ACCA and CIMA people that are doing. Let them do it. Yeah. So lots of workings you need to remember. All right. Okay. All right. Putting the camera off. Activity number 6. So look at this. Which pen I've taken? The normal pen. I need to take my digital pen. Let's read it, and I would expect a little bit working from you, at least non-controlling interest and goodwill. Like a charge PLC 75% of the issued share capital and voting rights of Stipple Limited at the date of the letters incorporation. The consideration is 5,000. To remember that goes into the goodwill, doesn't it? Extracts of the state financial position for the 2 companies are given. 31st December, by the way. PPE given and invested 5,000, which we already. And what else? Current assets given. Share capital. S&P given. Yeah, this is S and this is P. And retained earnings are current, non-current, and current liabilities given. What is information? Very important. Charge PLC has decided that NCI interest will be valued at its proportionate share of net asset. Every time you're going to see this word, that means the same thing you're going to do. Now, I'm not asking you to do this one. No, leave. I can ask you to group structure. You already know what is the percentage of the group structure. Let me check it out. It is 75%. So 25% is NCI. Do remember that one. So can you please work it out for me fully and give me NCI at acquisition, non-controlling interest at acquisition. I'd like to tell you just one extra information I'd like to give you here. The RE is nothing here. Retained earnings at the opening, you need to assume it is 0. Although it is not clearly given, they should have told us at the beginning here that RE because they didn't tell us anything about RE. There is nothing RE, but the closing retained earning is there. The closing retained earning, how much is that? 1,000. Because this is, I'm highlighting 31st December. So this is closing. That's only one I can help you with. Rest you can do. Can you please do the NCI? Some of you might have done it already. Please do non-controlling interest. Non-controlling interest. Hakan, Vivian, how you got this 1,000? Can you please give me the breakdown? They're saying it's 1,000. Non-controlling interest at acquisition. Let's assume this is one of our workings. Excellent. Well done. Let me write it down. Thank you, Hakan and Vivian. Share capital, right? Share capital of S subsidiary. How much at the beginning? It was 4,000. How do you know? From the question. Share capital, and it's 4,000 at the beginning. Okay, written 4,000, and I already told you there is no written earning because no information given at the beginning of the written earning. It should be 0. So the total worth net assets equivalent we say 4,000, but of that, how much you do not own? You own 75%. That means you do not own 25%, don't you? So 25% is your NCI, non-controlling interest. Taking the calculator on screen, 4,000 times by 25%, you get 1,000. That's how those people got 1,000. Well done, congratulations, you got it right. Easy, isn't it? That was easy. How do you get the NCI at the year end? NCI at the year end. Who does it for me? Do it for me, please. Non-controlling interest at the year end. What and what? 2 items only. The first one is basically copy paste. How it is saying it 1250. Rosie says 1250. Okay, that is not actually the way, Rosie, the breakdown you gave me. Yeah, will show you. Okay, I understood. That Rosie, you said 1,000 times by 25%. That gives you 250, doesn't it? 250. Okay, thank you, Hakan. What they're doing here is, let me tell you. This is all you need to memorize, people. If you don't memorize, you'll be looking for here and there the answer, wouldn't it? Non-controlling interest at the year end, the formula here is NCI at acquisition, isn't it? NCI at acquisition. How much is the NCI at acquisition? 1,000. We've done it already. Just copy and paste. That is called copy and paste. You need it. At first, when I asked you true or false answer, NCI at acquisition, why do you do it for GW? Which was great. And NCI at the year end, why do you do it for SFP? It's not financial position. Into the equity section it goes in. It's not enough, not done yet. You know, the NCI share of post-acquisition, NCI of S, or NCI share, we can call it. NCI share, especially retained earning. Once you bought, when you bought it, retained earning was 0, wasn't it? But after the year when retained earning was £1,000, right? £1,000. Let me take you into the question. I already highlighted. This is £1,000. Now, of that £1,000, how much you do not own? 25%. Yeah, 0 minus, like it's £1,000. Yeah, so from 0 it becomes 1,000. It is £1,000. So of that £1,000, 25% you do not own, which is basically 250. And 250 plus 1,000 is opening plus 250. It gives you 1,250. That is your non-controlling interest at the year end, and that goes into the SOFP. It's not just you need to know how to calculate, you need to know where does it go as well. Yeah? Happy with that. Now do me the goodwill calculation. Everybody can do it. Very simple. By this time it should be simple. You can take help from the previous work. What goes into this box? What goes into this box? And what goes into this box? Equals to goodwill. Give me the goodwill, please. You can take a couple of minutes here, 3 minutes even. Let me open my TikTok screen. Oh my gosh, 22, what is this? I don't know. 22 hours, 18 minutes. Was it open all the day and night? Okay, that's so funny. Oh, that was maybe 22 minutes. Give me the video. Are you saying Hakan and Rosie, you're saying 2000? Give me the breakdown, you know, I believe on the breakdown. Keep writing what goes in the first row, what goes in the second row, what is the name of it. Yeah. Yeah. Any of you giving me answer 2000, give me the breakdown. Okay, 5 plus 1 minus 4, even minus 0 is good. Great. Consideration is 5,000. That sounds good. Consideration is 5,000 plus non-controlling interest at acquisition. That sounds very good, which is 1,000. Yeah. And then minus net assets at assets acquired. Yeah, net assets acquired. So let's check it out then. First one, you need to memorize it, don't you? Consideration. How much we considered, how much we paid them. 5,000. 5,000. Consideration was made 5,000. 5,000. So in the first row, I write 5,000. I paid them 5,000 plus NCI at acquisition, isn't it? How much is the NCI at acquisition? We worked it out already. This is 1,000 NCI at acquisition. Write it down. Just add it. And you compare with the minus assets acquired or net assets acquired. Acquired, which is how much was that? Oh, I saw it there, 4,000, but I'd like to check it out from this question here. It is 4,000. Net assets acquired. 4,000 is the share capital. Yeah, because when you bought the share capital mostly unchanged unless they issue new shares, but retained earnings gets changed. So 4,000. That's how you got 2,000. Well done. That's another working. I'm glad you people are doing it good. Then it gives me faith that you can do a long question. I'm going to do a long question maybe when I come back after the break. Anyway, retained earnings, another workings. Yeah. If you remember, who remembers it? The parent retained earning and attributable from the subsidiary, isn't it? Do it, please. How much is the retained earnings? Do it, please. You can take a couple of minutes here. Within 2 minutes, you can do the retained earnings and you can write back to me. You can take help from our previous work. That's a part of learning. Lovely work, thank you. Let's see, it's from Rosie Consolidation. Oh, that was the earlier one. Khan has given me some answer. Parent and attributable from subsidiary. Well done. Okay, hold on a little bit. Attributable from subsidiary. Okay, that's how it's taken. Camellia, okay. Camellia, give me the breakdown. You still have 1 minute. Everybody has got 1 more minute. Do it. Thank you, Rosie. Parent one you have taken and subsidiary from attributable subsidiary. Well done. Great, Vivian. I'll straight take 2 minutes, so keep writing. Lovely work from you people. You're doing really great. I'm so happy. Okay. So basically, retained earnings. I said parent. All of you said is 1,500. It should be 1,500. It is still. I'd like to check on the question. Going up, up, up. Yeah, it is 1,500. And do you take all of the 1,000 from the subsidiary? No, we don't. own all of it, isn't he? So, attributable, basically, a subsidiary attributable. Attributable from the subsidiary. From 0 to 1,000, so all of it basically attributable, but from that 75% we own it. We means the parent, and whatever parents own it, it's going to go into the group. 750, and that's what it makes your answer 2250, right? Lovely, well done, good work. I appreciate your effort. You're doing it well. You're doing it well. Super. Now I am going to move into the next part of this chapter, which is intragroup adjustments. There will be sales and purchases, intragroup sales and purchases. It is very common that P is selling to subsidiary, even S is selling to P. It can be, but you know, when we do, P can show into their statements, S can show into their statement as a sales or purchases, no matter. But when you do combined, consolidated, it needs to be eliminated. Intergroup transactions should be eliminated. Okay. Now, what are the intergroup transactions? Receivables and payables. This is the easiest rule. If there is any receivables and payables, rule you need to remember, you need to think from parents' point of view. Yeah, parents payable to subsidiary, that would be deducted as receivables and payables from both of the parents and subsidiaries books. Okay. So in short, let's keep it simple. Receivables and payables should be taken away. Intergroup receivables and payables should be taken away from parents' point of view. Number one. Number two, there's some intergroup balances which you're going to do it. In number two, few items are there. A, B, C, you can see. Again, the C is basically repeated, receivables and payables. Let's talk about A. Adjustment for cash in transit. If there is something written, your cash in transit on the way. Cash in transit, the rule or double entry is cash debit. Cash goes up, receivables goes down, receivables credit, okay? This is one adjustment in intragroup transaction, all right? That's what you need to remember, learn it by heart. So if you see any adjustment in the further information, they told you that cash in transit, £5, £50, I've written 50, okay, £50. Your cash gonna go up and your receivables gonna go down. Make sense? You need to remember it. You need to learn it by heart, number one. Now, the goods in transit, yeah? If the goods are on the way from either party, parents or subsidiary, no matter, inventories would be up, inventories would be debited, and your trade payables would be credited. Okay, that's what you need to remember, learn it by heart. Inventories debit, payables credit. Both of these are going up. There's no doubt. Take my pardon. Yeah, inventories you need to make it up, and payables you need to make it up because the goods are on the way. Goods going to go up, and payables being created because we assume it's a credit transaction. And finally, this is a repeated one. What happens if there is a receivables and payables? We deduct from receivables, we deduct from payables. Both of this is going to go down. So payables debit and receivables credit into the, when you do the group works, group transactions. Let's do one small activity, which will make more sense. Then we're going to do another big activity, which will make more and more and more sense. Yeah. Okay. Activity number 7. People do remember it's just line by line add up. P plus S equals to consolidated. Okay. We don't take the 80% or 60%, 70%. We take all of it. 80% or 20% are already being dealt with into the NCI, non-controlling interest. Yeah. So and the shares being taken less, not all of it. Retained earnings being taken less, opening and closing. So it's being heavily worked out. So in a sophisticated way. So we don't, if we don't own all of it, we don't own all of it. That's been shown into the NCI. But the assets and liabilities would be added up line by line basis, all right? Let me show you. X Limited owns 80% of the equity share capital of Y. So P owns 80% of S subsidiary. X to Y So 20% is NCI, non-contributing interest percentage. X limited has trade receivables. Now, X limited trade receivables. Remember, it's not group trade receivable. It's not X owes to Y. It's just X limited trade receivable 20,000, and Y limited trade receivables is 50,000, 15,000. Sorry, yeah. X and Y. 20,000 they have, 15,000 they have. We normally should add both of it. That is the rule, line by line add. That's all we've been doing. Equals to our parent or consolidated. Consolidated should have been 20, 30, 35. Yeah, that should have been. But do we have any intra-group transactions? Trade receivables of Y limited included the amount 1,500, which is due from X limited. Mostly this will be done. So I think from X's point of view, it will be deducted from what do you call it, group consolidation. It will be deducted from the group consolidation. Let's see the requirement. Calculate the amount for trade receivables included into the consolidated. Yeah, they're asking you consolidated. Now, let me do it. I've already done halfway through. Like 20 is added with 15, which is great. But intra-group transaction, which is 1.5, should be taken away. Are you understanding what I'm doing? Yeah, I'm ignoring the 30. I should have taken the 30. 20,000 plus 15,000. That is the total receivable. That's fine. But of that receivables, there is an intergroup transaction, 1,500. It should be taken over receivables and payables as well, if there is any payables, to 33,300. 33,000 what? 500, not 33,500. Okay, let's check the answer this time. Okay. I think we have done all these things, isn't it? Have we not? Yeah, this I remember, but we didn't check because the balance sheet balance. That's why we didn't check all these things. When the balance sheet balances, we don't need to check it. Yeah, there you go, 3,500. Ah, that's the way of doing it. Don't mistake to take 80%. That's what I was trying to tell you. We do line by line add up. Yeah, P plus S equals to consolidated. All of you, we take it. The 20% is being dealt with into the NCI. Yeah, in a sophisticated manner. Great. Some of you have tried to answer me. I appreciate your effort. Okay, inventory sold at a profit within a group. Now, people, when P is selling to S, yeah, or S is selling to P, there's some rules you need to remember. This chapter and next chapter as well. But more importantly, if like P sold some of the items to S and S sold it to the outsider fully, then we do everything normal. There's yeah, parent is selling to subsidiary and subsidiary sold the goods to outsider. There is no profit unrealized. But what if parents has sold maybe 5,000 worth of pound of items, but in the subsidiary's account, 2,000 worth of items remaining? That means there are some goods remaining into the subsidiary. Knock, knock, knock. So what I'm talking into the subsidiary, and there are some profit. When parent sells to subsidiary, they sell at a profit, don't they? But the goods are still into the closing inventory of subsidiary, and the profits are not realized yet. Those profits are not, the goods are not sold outside and it is not being realized yet. We call it unrealized profit. And inventory, do you remember, remaining inventory creates unrealized profit. Provision for PUP, we call it provision for unrealized profit or unrealized. If the profit is not realized, what are you gonna do is profit unrealized adjustment. Please do remember, you're gonna make your RE down, retained earning down, debit retained earnings, because the profit is going down, it's not being realized, and inventory going down, closing inventory, because it is not being realized yet. That's why you need to take it away from the inventory. Okay, inventory goes down and retained earnings goes down with the PUP. Please do remember. A few more rules. These two rules are important. This one extra rule here from subsidiaries point of view. Okay, Let me summarize whatever you have learned so far. What is actually going on? One party is selling to another party, and at the year end, there are some items unsold. If there's items are unsold, provision for unrealized profit creates, and we need to do adjustment for this. Let's read this one, highlighting if the parent makes sales, how do you do the adjustment? P is selling to S. Parent is selling to S. Retained earning goes down by POP. You can write it down in the book. Earning goes down. And inventory in the face of the statement, even inventory goes down. Retained earning goes down and inventory goes down by the POP. So you need to work out the provision for unrealized profit. I'll show you how do you work it out. Provision for unrealized profit is basically the profit, how much you couldn't realize. Yeah, we will work it out. Simple working. It should be based on a scenario. They need to give us some figures. So a little later, we're going to see some figures. Okay, that is from whose point of view? Parents' point of view. Yeah, RE goes down and inventory goes down. Simple. But when subsidiary makes sales, subsidiary sells to parent, S sells to P. How do you do it? One extra item you do into the non-controlling interest. Look, you will still deduct from retained earnings like parent. You will still deduct from the inventory like parent, but this is the new one, the middle one. Non-controlling interest working. You deduct from minus from non-controlling interest. NCI, closing NCI, year-end NCI. Okay, see, you need to memorize it. So at this point of time, I'd like to give you a quick tips, accounting tips. You can ask me, Elias, I'm getting already so many formulas. The answer is yes, and it is not done yet. Next lecture, we're going to get even 20 more formulas. So how do I do it? My answer to you is take a piece of paper, tips, and start writing. Working number 1, working number 2, working number 3. And what are the possible items? Like if you started with GW, what are the possible items goes? All the possible items, yeah? If it is a non-controlling interest at acquisition, what are the possible items? Write it down. Non-controlling interest at the year end, what are the possible items? Look at this. This is a possible item can go. Non-controlling interest will be down by PUP. Will be down by provision for unrealized profit. And what is the provision for unrealized profit? When a subsidiary or parent sells to each other, some of the profit not being realized because it's not being sold to the outsider, it still remains within the group, which needs to be eliminated. Right, so much talky, a little bit of worky. Let's do some worky. To be honest, I'm short of time today, like because I have to discuss everything in detail. I thought by 11:30 I would be finishing at least activity 8, but activity 8 is just there. We're gonna start activity 8, but won't finish it. I know. See, when you work hard and smart and attentively, how fast the time flies. It's 1 hour 30 minutes already almost. Yeah. So time flies, isn't it? That means people are working hard. Although it's me talky, a little later. Yeah. And I hope you need a coffee as well after this illustration and a little bit of activity. Focus. Illustration number 8, intergroup sales. Gilbert Limited owns 60% issued share capital of Woodford Limited at the year end. Woodford is a nice town. The statement of financial position showed inventories of 100,000 and 50,000. Okay, so respectively means Gilbert 100,000 and Woodford 50,000. No problem. Let's keep it simple. Normally we know we need to add line by line. That is still our thoughts. Gilbert Limited sales. Now P is selling to S. Yeah. Now we got to apply 2 formulas only, not 1, 2. RE goes down. Yeah. With the PUP, there will be PUP definitely. Provision and we're going to work out the PUP. And your inventory gonna go down. Yeah. Do remember Gilbert P is selling. And when S sells, 1 more extra. NCI goes down. Yeah. But the markup 25% on cost. You already know by now. I have a fantastic video on markup and margin on my YouTube channel. You can check it out. Or like cost plus profit equals to sales And if cost is always 100% and profit is 20%, that is your markup profit. And sales is 125%. Cost plus profit is basically your markup, okay? Cost plus profit is your markup. Now, couldn't get even enough space there. Okay, let me do it here. Cost plus profit equals to sales. Yeah, that's how we do. And if it is a markup, 25%, markup is a profit. Markup profit plus cost would be 100%. Equals to your sales will be considered as 125%. That's a very good formula to convert markup into margin, or just strictly markup. Markup is a profit which you apply on cost, yeah, not on sales. Anyway, that's so far so good. At the year end, goods which had been purchased from Kilwood for 30,000 remained in the inventories of Utford. So this is a, what do you call it? The inventories Kilwood sold to B sold to S Utford. Was the 30,000. Okay. How much is the PUP here? PUP. All of it remaining into the closing inventory, but how much is the provision for unrealized profit? How much is the profit that is being unrealized? P is selling for 30,000, isn't it? P is selling for 30,000. And there is a profit, and you need to find out the profit using the formula. Using the formula. Selling price is how much here? 30,000, isn't it? I'm taking another color pen here. Let me take another color pen. 30,000 is the selling price. Of that, 25% is profit and 100% is cost. And this 30,000 represents 125. That's why they do this one. They did this simply, but I have gone a little extra mile for your understanding. So 30,000, taking the calculator on screen, look at this, 30,000, which represent 125% divided by 125 times by, if I do 25, that gives me 6,000. That means profit is 6,000. Hope it makes sense. If you still need further help, you can Google or YouTube, my YouTube channel, markup and margin conversion. So 6,000 is your PUP. This is the W for PUP, 6,000, which makes your RE down and your inventory down. Let's see what is given here. There, what is the question, by the way? Calculate the amount of inventories that should be recognized in the consolidated. In generally consolidated, we add P plus S equals to whatever. So this time P plus S was 100 plus 50,000. Yeah, 100,000 plus 50,000. It should be 150,000. But what is the rule with PUP? It makes your RE down and CLO in down. This time CLO in down by 6. Makes sense? 144. Yeah, that's the 144. Look at this. 100,000 plus 50,000 equals to, it should have been 150 minus PUP. They didn't show you the retail earnings because the question didn't ask you. The question is not a big question, it is a small question. Okay, that is your provision for unrealized profit. Well, you have to realize these things. And I thought I would be able to finish activity 8 by the end of 11:30 today. But actually it is not like that. Now, activity 8, look at this opening talkie, which is very important, you know. These are not that important. Little obviously needed, but not that a headache. But yes, can you see 1, 2, 3, 4? Yeah, cash in transit. Remember the rule? I'll take you to the rule. Yeah. Then receivables and payables, we think from the P's point of view. So this is one gonna go. Then there's the inventory sold. There's a cost. Cost minus sales, you get profit. And how much is there? Half of it. There were two PUP, provision for unrealized profit, and we're gonna do it proportionate basis. That means quite a bit out there. Quite a bit out there. A little bit of workings are there. I'm not concerned about this one. This pro forma we can do. Nothing much add or less, but more concerned is what is the NCI at acquisition? Got to do it. Yeah, and group structure, you can do it. Group B owns what percentage of S? No, NCI at year end, you got to do it. Adjustment cash in transit, do you remember? Cash in transit. Cash goes up, receivables goes down. Intergroup cancellation, receivables and payables. From P's point of view, both receivables and payables goes down. You remember? Yeah. If it is not, you need to go to the formulas that is given. Then in the receivables, P plus S minus intergroup transactions, yeah, minus anything else, plus minus. Goodwill is there, inventories are there. Inventory, the PUP will be deducted, you remember? Retained earnings